All right, we are live. What's going on, everybody? How you doing? So today we're going to talk about. Today we're basically going to go over the macroeconomics, kind of what we're seeing in the market, right? So if you're an investor, let's say you're an investor, right? You're an investor, maybe like crypto, maybe you're into stocks, tech stocks, value stocks, whatever it is, or you're just trying to evaluate the economy. And a lot of people are confused about what's going on here. I want to present this macro report. There's a lot of confusion in the market, and you hear a lot of things. We're going into a deep recession. We're headed higher. There is no recession. So I just want to bring some clarity to the space with the macro research that I do. Bring some clarity and kind of give my take on what's going on here. So we're going to jump into it. Let's jump into it. Let me see. We're having a little. Oh, that's fine. Okay, cool. So we're going to jump into it. Let's get to the macro report. Let's just jump straight into it. Make sure I got this. Get this right. Okay. So basically, what I think is going on here is we're basically looking at this. Where are we at in the market, first off? So what are we kind of looking at? Let me make sure I got this. I thought there was a better view. Oh, well. Anyways, what we're looking at here, I think, is a lot of FOMO coming into the market. So we're looking at FOMO, right? We're seeing the market rise higher. We're seeing NVIDIA at all-time highs, Apple at all-time highs. And the question is, is this overbought? Are we overbought? Are we coming back down? Are we headed for I see a lot of people on social media saying that, okay, we're not going to the lows again. Maybe we're not going to the lows, but we'll go to all-time highs and then we'll pull back. Whether, they're not even bullish on crypto. Maybe it's just the tech stocks, or maybe it's just the S&P 500. And the view is that we go, we experience a recession in the second half of the year and we pull back and the stock market comes all the way back down. Now, according to what I'm looking at, it just doesn't look like we're experiencing that. So I kind of want to talk about this wave 2 FOMO. We've seen wave 1 FOMO, and wave 1 FOMO was basically, we had the debt ceiling, we had the debt ceiling resolution. And right after that resolution, we saw the S&P 500 break out over that 4,200 level. That was the level where people were short and saying we can't get above that level. So we broke over that. The next narrative was, the liquidity drain. But either way, we've had this FOMO, and this chart that we have up here is basically showing us that wave 1 FOMO. So what we had was, and you know what? Let me make this bigger. This doesn't look very good. I want you guys to be able to see these charts. So here on the left, we had peak CPI. This is the Nasdaq, right? And the reason I'm looking at the Nasdaq is the Nasdaq has been leading the market higher. Technology has been leading the market higher. And you hear, oh, it can't last. There's only 7 stocks in the market doing it, but there's a reason why. There's a really good reason why. So we had peak inflation back here. Market kind of came back up. We rolled back over because inflation was a little stickier. And then global liquidity started to come in. We started to bottom in the Nasdaq, and we finally broke that trend. And we've had FOMO ever since. The Nasdaq has been extremely strong. It's up over 25, 30. I think it might be up close to 40% from the lows. Either way, we had that wave 1 FOMO. And I think what we're about to see is actually wave 2. I think we're headed into wave 2 FOMO. My prediction is that we see all-time highs, and I got a couple of reasons why. These are 4 reasons why the bull market continues, why we keep seeing that. Now, the first part here is, back a couple months ago, we've had the most negative short positioning in the S&P 500 that we've seen in 15 years, and it actually got worse than that. I believe it was the worst negative positioning in the last 20 years. So this is sort of that chart. CFTC S&P 500 net negative positioning. Everyone's short. Hedge funds, institutions, economists. Second half of the year, we're going to collapse. Global liquidity is disappearing. Everything's going negative, whatever, blah, blah, blah. And what we really saw during that rally, and we talked about, hey, this is a potential short squeeze. We could see this. We hadn't seen this high of negative positioning since 2008. We just hadn't seen that. So what we saw is after the rally, now that short positioning is starting to squeeze back up. And so that squeeze, or that positioning starting to go back up, is shorts starting to cover their positions, right? So that squeeze kind of set off this rally. And now people might say the bears, or if you're bullish, maybe you're like, hey, we're going all-time highs, great. Now let's kind of, weigh what are the upside risks? What are the downside risks? I think there's a lot more upside to this market. for a couple of reasons. Not only the short squeeze has more room to go, we're still at negative 5%. And I think this thing just squeezes all the way back up, given the backdrop, given the negative sentiment that we're starting to see. I bet this rally continues. And number one, and let me put this banner on here. This is the first reason, okay? Inflation collapse. This is what I believe we see this inflation collapse. And what we're seeing here is the first of all, you got to realize here that energy is the largest component of inflation. Okay, energy is the largest component. Inflation was at 9% when oil was at 130, right? That's when we saw the highest inflation. Now that oil prices are falling, right? And this is kind of the premise to this idea, we're starting to see inflation abate. Now, global manufacturing is the leader to energy demand, right? The more manufacturing leads the global economy, according to the work I've had and other people in the space, the PMIs or the ISM manufacturing indexes kind of lead demand to create goods, not services. We're talking manufacturing. And when we look globally, those manufacturing indexes, so delivery times, new orders, stuff like that, for industrial goods, whatever it is, refrigerators, cars, home appliances, blah, 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 those things are in negative territory, right? This is the 50 level, and we're seeing here, this is US, Europe, and Japan, and they're all in negative territory. They're pretty much declining. So manufacturing will lead oil demand, and that is starting to fall. Next chart, and I'm going to go through this relatively quickly. Western Europe. So you look at Western Europe, and what are we seeing? Germany, UK, France, same thing. Their manufacturing index is in negative territory, pointing or leading us to lower demand for oil. Until that turns up, oil demand, I think, is suppressed. And this is just one reason. Look at East Asia, China, Taiwan, South Korea, and we're seeing negative territory below the 50, above 50 is expansion and below 50 is contraction. So we're seeing basically a contraction happen here in the manufacturing sector. Okay. Now, number two, this is an important chart. This chart pretty much sums up my thesis on why oil is going lower. And obviously, we already talked about the PMIs, the ISM PMI, those are going lower. And that typically the business cycle or business activity is led through manufacturing. And we're seeing that lead lower, right? We're seeing that go lower. So I expect oil demand or oil prices in general to drop to the 50s or the 60s, which is a shock. A lot of people expect $100 oil. We've been hearing that for a while. And I think that is the biggest risk to the market is that oil prices start to surge back up because it's such a large component, right? But I think we get sub 60, and here's why. Number one, manufacturing is still in recession territory, and it doesn't look like it's rebounding anytime soon, maybe in the next couple months, but it's still in recession territory. Number two, there is a war for market share. And what I'm highlighting here is basically Russia and Iran are selling cheap oil to India and China. At one point, they were selling oil at $37 a gallon. And, that's the lowest point. And it was a little while back, but they're selling cheaper oil. And basically, they're capping the prices. The Saudi, back here where, I have NOPE, what this was is the Saudis cut production. So, if you cut productivity, then prices usually surge. And we saw that bounce, right? But we couldn't get past this 83.50 level, got rejected. Next thing you know, they're starting to signal again. This is the Saudis. Hey, we're going to cut production again. They want to get those oil prices up. They want to squeeze all the shorts that are shorting oil. The problem is you have these other countries, you have Russia and you have Iran selling cheap oil. So they're onloading supply at such a cheap price. It's really hard to get. Now, here's where where I really think this thing collapses is Saudi Arabia. If they keep cutting production, they're basically giving market share over to Iran and Russia because Iran and Russia are producing more while they're cutting their production. I don't think that lasts. In my view, I think there's going to be a war for that market share, meaning Saudis have to start pumping again. They have to increase their productivity. So that's the second sort of wave why oil prices are going lower, i.e. inflation. And the third wave is secular. The third wave is basically this virtualization of the economy, right? Zoom, Google Meets, Microsoft Teams, everybody social meetups online, right? Discord, Facebook, blah, 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 Twitter. So what that kind of points at is business activity, or in general, business and social meetups are becoming more virtual. That's less travel, that's less demand for oil over time. Now, that alone, is it enough? No, it's not. But when you add the three together, manufacturing declining, you have a war for supply increasing, it's selling at lower prices, and then you have the secular move to virtual economies. I think oil goes lower. And that's the first input to seeing inflation really start to collapse here, right? Now let's move over to the second part. The second part is core. The only reason core inflation is so sticky is that it's actually lagging, right? So the last argument really for inflation is that, oh, core is sticky. We're going to stick around here a little longer than expected, but I think that actually collapses because sticky is just another word for lagging in real time. So what we do know about CPI, now this is a chart of shelter CPI. This is really what's keeping inflation hot, other than services, which I argue, okay, great. Services are kind of sticky. That's not terrible because it's keeping the economy stronger than expected, at least, right? It is the shelter component, the rent prices that are really negative, hurting, keeping the Fed from really cutting rates, or keeping the Fed from reversing from this hawkish stance to this more accommodative level. So we need that to come down. But in real time, what we do know is that Zillow, so this is Zillow rents, what we do know is in real time, Zillow rents is the real time. It leads by 6 to 12 months, right? So that lead is basically collapsing. We're at 4.8%. And I know, 4.8 is still kind of hot, but it's still pointing lower. So that should lead CPI shelter, which inputs to the Fed's inflation gauge much lower than this. That's just one, right? If we look at major metro shelter inflation, it's also in negative territory. This is US Case-Shiller Home Price Index, aka metropolitan cities. So the biggest cities, the average rent price or the average home price in those major cities, it's already below zero. And that doesn't mean prices are dropping like a rock. They are in some areas, they actually are. But what it does mean is overall, the macro, when you look at the macro, home prices are coming down. That should push down shelter inflation. More evidence here. When you increase supply, right, of something, price goes lower. And as long as demand is not going up. And what we're seeing from Redfin, which is another data point here, Redfin, rents, right, Zillow, blah blah blah. They're companies who basically are in the housing market. What they're showing is that there's a lot of new supply coming online, and this is like a 20-year high that we're seeing. A lot of multifamily homes. Yeah, this was back in March, so this data is a little older, but it's still, the secular trend is still going higher, and we're seeing multifamily supply coming on to the market. And you might hear there's less supply. Well, you know what? Maybe for certain single family houses, there is less supply. But so far, we're seeing for these multifamilies, these apartment rents, these units, these bigger units, we're seeing more supply. The old supply is also increasing. So that's more pressure to push prices lower, as in shelter inflation. The old supply, because rental vacancies are at the highest level in 2 years. So basically people, and I think this is really a secular trend, what we're seeing is people are saying, hey, this is too high. Rates are just way too high, right? Interest rates are too high. I can't afford it. I'm moving in with my parents. I'm moving in with my friends, and we're going to stack up there so that that old supply of rentals, people renting, are basically leaving. So you have more supply in the market, and that forces landlords to lower their prices to attract more tenants. Okay, more Redfin data. Basically, their rental prices are falling, and this is all really to say the only reason that we're here, right? This is all really to say is the biggest inflation narrative to the downside is that core is going to remain sticky. But as we see here on these charts, we're seeing that it's not the case. In real time, maybe this changes, but in real time, shelter CPI is set to collapse. I think it happens at the end of the summer, maybe August, and that's going to be very bullish for the market. And that's why this ties into why the market is set to keep going higher, all-time highs for Nasdaq, S&P possibly. Right now, when we look at some of the correlations, we go back and we say, okay, anyways, this chart right here, what this is by Raul Paul GMI, the average trajectory or the average performance of the S&P 500 following the peak CPI for the last 70 years, right? We are right on target. In blue is the average performance for the last 75 years following that peak CPI here at zero. So right after CPI peaks, we don't really know it peaked. So the market, still trying to find a bottom, finally bottoms, goes higher. So this basically tells us that this is not abnormal to see the market rip higher after CPI has collapsed below 6%, right? Once we get under 6%, We went from 9, now we're at 4, and we're falling pretty quick. That's pretty bullish for the market. It's like it's an interest rate. Inflation is an interest cut on earnings, and now that it's coming down, you could also argue inflation does help earnings, but it really depends what you're looking at here. So number 2, here's the second part. Now, one of the negative catalysts, right, is that people are bearish on the market is we're headed for this deep recession, right? Everything's going to collapse. We're falling apart. Consumers, savings rate, blah, 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 student loan payback, whatever, right? And we did have a recession. We did have recession back here, right? We had negative GDP for a couple quarters, okay? And now what we're seeing is we are slowing down. So one thing you got to keep in mind is that just because GDP is falling, this is the growth rate of GDP, doesn't mean that growth is, you're headed into recession. What it means is that you're still expanding. As long as you're above 0, it is the rate of growth. The rate of growth is coming down. But what really marks or signals a bottoming of GDP is when the estimates are getting beat. So we came in at 2% GDP. If you annualize it every month, so it's not like literally 2%, but when basically to sum it up quickly, we're looking at 2% GDP, right? When the estimates are at 1.4, so we're beating by a sixth. That's a big number, right? And that kind of suggests that growth is coming in stronger than expected, which means, hey, yes, we're slowing, but at some point we might start to pick up, and we're going to get into that a little further into this report. We're going to get into why exactly. Actually, that's next. Why is growth going up? Here's why. Okay. First off, the market leads the economy. Okay. Get this through your head if you're not familiar with this, or maybe this is new for you. The stock market leads the economy. It does not wait for the economy to make a move and then react to it. The stock market is looking 12 months ahead, 6 to 12 months ahead. That's the idea. That's what it usually does. And what we're seeing here in this sector, this is the U.S. construction ETF, ITB. There's many ETFs. Why is it at all-time highs, right? Why are we seeing home builder ETFs if the housing market is falling apart? And I'd argue that the housing has been in a recession, right? In certain areas of the U.S., we've been in a recession for housing. We've seen all these home sales at negative, going further down, not selling off, but just all the readings were down. But now we're seeing the ETF start to recover before the housing market has ultimately came up. And there's a reason for that. So people are bullish on construction. Why is that? Well, not why is that, but here's some more evidence to that. Using U.S. housing sales are starting to bottom. This is one signal that tells me, the economy is stronger. It's not collapsing. It doesn't continue to collapse. It's actually starting to bottom here. So we're seeing this bottoming effect, right, in pending home sales, existing home sales, and new home sales. It's starting to bottom. Now, could it roll over? Sure. But for the most part, in the intermediate right now, as a coincident indicator, these sales are not rolling over. They're still, they're starting to bottom, and there's a lot of data that suggests this at least stays, doesn't roll over more, but it kind of stays where it's at. Maybe it goes higher, and we'll actually see. We know people are building. Number 2, home builders are building for sure. More supply, lower prices, right? Home builder sentiment. So the what is it? The NHIB survey. This is home builder sentiment has bottomed pretty much, right? From a very low point, it's starting to shoot up. So home builders are getting more confident about bringing on supply. Now, the thing that's important about home builders is why would they want to make money. They're not here to just make random. They're looking at a lot of data, and they see that there is demand. There is a demand to build more homes. When you're in a recession, the home builders continue to fall. Home builder sentiment is negative. They don't want to build because they're going to lose money. So they're saying, hey, we can. So we actually see building permits. And I saw somebody say, hey, building permits are down. No, they're not. Building permits are starting to bounce. Are they in negative territory, recession territory? Yes, they are. This is all recession territory. Don't get me wrong. We're in recession territory for housing, but when you look deeper into the data, it is starting to bounce. So you really need a narrative or a catalyst to have confidence that these home builder survey or this home builder data continues to go higher. And we are going to get into that. There's a very good reason why this housing data continues to go up while prices decline, which is great for consumers. Okay. Now let's turn to the labor market, because this is really number 2, the most important thing here. Right. Let me change the banner because we're on no recession. Basically, we're here. I forgot to change it. This is no recession, right? We just went through it. What is it? GDP GDP is better than expected. The housing market is starting to bottom. Now the labor market. Let's look at the labor market. We are still at historic lows in unemployment. And back earlier in the year, I thought there's no way we're going to go higher. The unemployment rate has to spike. And right now we're at like 3.7. We'll get a new reading this month. We'll see where it's at. But we're at 3.7. We're still at historic lows. I think we can go to 4%, but that puts more pressure on the Fed to actually cut rates or to not be as hawkish as they are, which actually eases the economy. Now, part of the reason the labor market is so strong is because, or unemployment is not spiking yet, is because people still have jobs. There's still payroll. So even though we're in this rolling recession, things are, what is it? Housing, manufacturing, technology, financials. You see a lot of tech stocks or a lot of companies that are cutting, they're cutting their employment. But there's enough jobs. Job openings are still elevated. They're coming down, but they're still elevated. So people might lose their job or they might change their jobs, and there's more available jobs. So this is just a reflection that the housing market is still pretty strong. Now let's turn to the consumer, right? This is the other part of the economy, the consumer. We see in my view, the consumer is hanging on here. I think what's really happening is the consumer is bracing for a recession. You've all heard, oh, we're going into a recession. When you already know something's going to happen, or you're pretty much prompted to behave as if everything's going to fall apart, you start to save more. So here in orange, what we're seeing is the savings rate has been climbing ever since July of 2022. We've seen the savings rate climb, and incomes right now, incomes aren't spiking, but the income rate this month, or this last data read, was higher than last month's. Excuse me. So incomes are not falling apart. We're not in negative zone, right? The red is negative. We're not negative yet. So yes, the economy is slowing like we saw with GDP, but it's not falling apart. We're not going negative. The moment it does is the moment, my narrative, or the way I'm looking at the macroeconomics and the stock market, is the moment that I kind of say, okay, something is changing, right? But so far the signals point to growth remaining strong. So incomes are still positive. Okay. The savings rate is still positive. Spending month over month actually went lower. So that kind of reflects too, hey, people are bracing for recession because, incomes are actually, and this is month to month data. So it's not like, a true trend. It's really not a true trend, but either way, we're not getting exuberant spending, and incomes are, where they're at. They're staying where they're at. This month is actually really good data for the Fed to look at, because they're seeing that people are not spending, like crazy, because, they're slowing. They're bracing for recession. Now, the only reason the economy is not falling apart, because we've already looked at the PMIs, the manufacturing sector, and it's all negative. We're in recession, right? But the services economy is strong. So I always say this: you look at any kind of service, whether it's insurance, whether it's a travel, whether it's your insurance, or whether it is, your cell phone bill, or, maybe it's Netflix, whatever you're paying for, people are still paying for that. So the service economy is still expanding, right? Now, this is global services economy, right? And this isn't the actual, this isn't services sales or anything, but this is just looking at the purchasing manager index of services globally. And we're looking at in black global. Basically, we're above recession territory, right? 50, the gray area is recession territory. Could we dip to recession territory? Sure, we could, but I'm not seeing that, because forward-looking indicators, we're going to get to that, are basically telling me that the consumer will continue to spend. And at some point, maybe it takes a couple quarters, we start to see growth return and it start to accelerate, right? So let's say services do roll over. Okay, they're okay right now. That brings up my next point, right? That brings up this is really why I'm bullish. This is why I think we're really headed into an expansion. Regardless of what you hear, oh, we're going negative, things are going negative, blah, blah, blah. Yes, if we get a black swan, I think things do fall apart. But when economies slow, the only answer is more cowbell. What is that? Ding, 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 right? You ring the cowbell, you're on the farm, lunch is ready. And that's sort of what this is, which is more stimulus, right? This is a central banker printing money. And I think this is where we're headed. We're already seeing it happen in China and Japan. They are printing more money. They're cutting rates. At least China is cutting rates. And stimulus, or liquidity into the market, is what the stock market can keep fueling off of. The stock market, if anything, is correlated to liquidity trends more than anything. So cash coming into the system minus exiting the system. Okay, so I think more stimulus. The answer to slower growth is more cowbell. And so what we see here is when things did fail, you guys remember the the banking crisis with Silicon Valley Bank, who was it? All those regional banks that were falling apart, and there was a crisis. Everybody got scared. Oh my gosh, should we sell? Well, the stock market actually went higher, right? And this gray area is highlighting that time when the U.S. bank regional banks fell apart. Some banks almost went to zero, but overall, the macro regional banks fell hard. And what we saw is that the Fed injected more liquidity into the market. Bitcoin rose, the stock market went higher. It sort of bottomed at a level. We did not fall into a deeper negative level on the S&P or the Nasdaq. We went higher because, like I said, when liquidity comes in, that's going to fuel asset prices. And there's a lot of confusing, there's a lot of confusing narratives about liquidity, and I'm here to square that up as best as I can. Maybe I'm wrong. Maybe I'm wrong. Maybe you have a different opinion. I'd love to hear your comments on that if that is true. But for the most part, this is what I'm seeing. If you have comments or whatever, throw them out there. So this is the strongest thing. First, that was Fed liquidity, by the way. That was Fed liquidity. Now, you also have fiscal liquidity. So fiscal liquidity is the government creating, printing money or, spending. Government spending is fiscal liquidity. And what we're seeing, or what we have on deck, basically for the till 2026, is, I say this: the best way to get reelected, Joe Biden, is more stimulus, more cowbell. The infrastructure bill is $1.2 trillion. Okay, power grids, freight, rail, blah, 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 roads and bridges. That is online. This is the main reason we're not seeing the labor market fall apart, in my view. Maybe I'm wrong, but there's spending happening. And when that spending happens, you're starting to build. You need construction workers, you need building permits, you need stuff to be built. And so you hire people. AI is not there yet, although it is in tech. It's not literally in the, in the labor and the hard labor, the blue collar jobs. It's not there yet. So point being, infrastructure bill, $1.2 trillion. CHIPS Act, we already heard this. This is why semiconductors are exploding. This is why NVIDIA is at all-time highs. This is why AMD is exploding. This is why Taiwan Semiconductor is moving higher, other than AI, which is the investment, the fiscal liquidity or the fiscal investment into the CHIPS Act. Wait, $280 billion. And what does that mean? It's really a bid for technology for the US to not fall behind, to onshore all of the chips here. We don't want to rely on China. We don't really want to rely on other, countries outside of our country. We don't want to rely on other manufacturers to bring us technology. We don't want that because it is a risk to, global stability, or at least the U.S. dominance. So we are now funding the CHIPS Act, or we're funding chips, and this also goes into education, whatever it is. Either way, more liquidity, right? More liquidity. The market sniffs this out. And we're seeing NVIDIA and all these other semis go higher. The Inflation Reduction Act, $650 billion. This reaches out till 2030, but it's basically a bid into growth, right? The growth bid remains. And this is the electrification of the economy. This isn't even the whole bill. It's 650 billion, but where does this pour into? So this is fiscal liquidity. So we know the Fed prints. We know that the Inflation Reduction Act, we know the government's printing, right? And that all is going into technology, which is probably why, in my view, the Nasdaq is exploding and everybody thinks it's overbought. And I think we're just getting started, right? Next, Bidenomics, right? The White House will keep stimulating the economy. We just got this last week, which is Biden announces a $42 billion high-speed internet initiative. And the whole point here is that as long as the government keeps spending, like, there's going to be liquidity into the economy, or at least into capital markets, which is exactly what stocks or risk assets want to see. Okay, and yes, it's more nuance of that, but in general, that is the idea. That is the idea here. And who's benefiting? Renewable energies, electric vehicles. You see Tesla moving much higher because these are basically stimulus checks to these companies. It's incentivizing them to build, right? Energy storage, AI, semiconductors, all that goodness, right? And blockchain too. Now we're seeing the Bitcoin ETF from BlackRock, and they're talking about tokenizing ETFs in general. So a lot is going on here. So more stimulus means higher asset prices. So you see the Fed liquidity, as the Fed printed right down here, as they started pushing, and the liquidity has been draining for about a year. But ever since that banking crisis, liquidity exploded, and crypto bottomed, and tech stocks bottomed, and they went higher. And AI was part of this narrative too. But overall, liquidity is making a return into the markets. after being in a a bear market for a while. Now, this next part, basically what we saw is the biggest risk to the market. And I want you guys to kind of frame this. So think about this really quick. Think about this really quick. I think volatility risks are basically evaporating, and all the biggest risk to the market, I think was I always say is inflation, and I don't even see that risk anymore. Inflation is coming down. We see it in every area, and growth collapsing. Right. Liquidity is also another risk, even though it's going up. What happened was during the debt ceiling crisis, everybody was bullish because of the debt ceiling, right? If they sign the debt ceiling, if they resolve the debt ceiling, of course markets go higher. The government can spend, but what people didn't understand is once they sign the debt ceiling, what happens is banks or money market funds, they basically have to purchase U.S. Treasuries to it's called the TGA account. They basically have to give money to the U.S. Treasury by buying their assets, right? So that's a liquidity drain. So a lot of people are very bearish on risk assets going into the summer and said, hey, it's going to be bad second half because all this money has to come out of the banking sector and it has to go into the U.S. Treasury. And then other people said, well, if it does go to the U.S. Treasury, they're just going to keep spending. That's bullish. And a lot of people just don't agree. But now that risk is starting to dissipate, and here's why, right? And really the reflection of this is bond volatility. This is very important. Bond volatility is coming down, S&P volatility is coming down, and this all just happened to coincide with Fed liquidity going higher, right? So it's kind of like, okay, now we know the trick. The Fed prints, liquidity comes into the market, or the trend at least changes, and markets are, more positive. Markets, the risks are coming off the table. Now I thought, okay, well, what about this debt ceiling crisis? What about what's going to happen here? And this is a little complicated. So, but this is a learning. If you really want to, if you're really confused, this kind of puts the nail in the coffin for me. This puts the nail in the coffin for me, which is that liquidity risk, where the TGA refills, what they called it, where the banking sector had to buy into the U.S. Treasury, taking out $1 trillion. But what we're actually seeing, right? And I have it up here. If you, I have this in the notes. If you want to read this whole report, the U.S. Treasury is actually targeting the money market funds. Okay, so let me try to explain this so in a way that you can understand it. All right, that's a little simplified. It's very complex. So, and I'll throw the visuals up there. So basically, if you are a bank, right? If you're a money market fund, all of you guys know about the deposit flight. The reason the banks fell apart was because the money market funds basically are offering what a lot of interest for you to park your cash there. So people are taking their accounts and they're leaving the banking sector, the regional banks, saying, why? I'm getting less than 1%. Why would I stick here? They're moving their money to money market funds, Charles Schwab, BlackRock, whatever, and they're getting interest there. And the reason they're getting that interest is because the money market funds are parking their cash at the Fed reverse repo. This is a facility, or you could say an account at the Fed, where they literally pay interest, the Fed funds rate, the interest rate, they pay the interest to whoever parks their cash there. That interest is around 5.4% right now. I could be wrong. I could be a little off on it, but it's not, that's not significant. The fact of the matter is they're getting paid interest. So they're taking their money, that interest, and they're paying customers who park their money there. Therefore, you get a bank run, right? You get all these banks losing their deposits because people are moving their collateral to the money market funds who are collecting cash from the Fed. So that's basically what the banking crisis was. Now, what we're seeing is money market funds. Now, the reason why now I know that's a little complicated, but I wanted to stick that in your mind, because the next piece to this is, why would people, or why would money market funds keep their cash at the Fed for that 5.4%? And let me bring this up. Why would they keep it there when they can buy US T-bills, right, and get more yield? And this is why that risk of liquidity from the TGA is non-existent at this point. Because, and I could be wrong, this could change, but basically, why get 5% for 12 months? Why would you collect 5% at 12 months? This is from the money market funds point of view, when you can get 5.5% in 3 to 6 months. So at a shorter time period, you can collect more interest. So basically, all that liquidity that was supposed to rip from the market and rip out from risk assets and take liquidity out is actually coming out of the reverse repo. Now, one important factor here is the reverse repo got up to $2.5 trillion. So the reverse repo collected $2.5 trillion of cash or collateral. That is basically quantitative tightening, right? So this whole time period, you've seen a quantitative tightening happen, which is a sucking, or the reverse of an injection would be taking liquidity or taking cash out of the system. And now we're starting to see that cash dump back into the system, right? And where is it coming from? It's actually coming from those money market funds. So as that cash is dumping, we're seeing the TGA cash start to rise. So basically, it's a non-event because you're getting reverse repo facility cash. Just go and basically back or build the government's TGA. And what is the government going to do? They're gonna keep purchasing, right? We should see Biden, or at least this administration going into an election year, continue to print money. We should see them continue to print money at some point, and maybe they don't, but I still think more liquidity is coming. So if there are any surprises, now this is kind of the nail in the coffin, right? Is there's no big volatility risks because the TGA refill is a non-event because it's coming from the Fed. It's coming from the Fed reverse repo, and there's still $2 trillion in the reverse repo. So you still have, if some kind of event happens, or if there's if somebody needs liquidity, the Fed could literally cut rates, pause, or do something, or the U.S. Treasury offers more bills, more short-term debt in order to get that reverse repo cash out of that system and into the capital markets. And I think that's just what we're going to see as things start to decelerate. So the TGA builds, the TGA build, or the money going into the TGA, the Treasury General Account, means the government can prevent a recession with fiscal stimulus. And I think that's exactly what we're seeing. We're seeing, Biden continue to do more spending. And he already said in his last press conference that he's going to rebuild this country back, right? They're going to keep spending. We know politicians love to spend money because it's going to help their vote. It gives confidence to the economy, XYZ, blah, blah, blah. So we should see more liquidity, and that's not going to hurt the markets. That's going to push the markets higher. Do we get a correction? Sure. But for the most part, I think we're headed higher in the macro. If there are any surprises, right? Let's say there's a surprise, there's a black swan. Well, just like the regional banks, there was a black swan, things fell apart. The Fed cuts rates, the balance sheet grows, voila, asset prices go higher. And that's what we saw. So the biggest risk is really still inflation. That still remains the biggest risk. And I just don't think it's the actual risk. Like, if inflation goes up, we're in trouble, because what can you do with that? How can you solve inflation? You really can't. But let's see. Yeah, you really can't solve inflation, but you can solve a recession. And that's always been the thing, is if a recession takes place, then, or if we do start to slow, let's say the unemployment rate goes up. Well, if the unemployment rate goes up, right? If the unemployment rate goes up, then the Fed can we have a lot of tools. The Fed can lower rates. They're already pausing right now. Maybe they hike and they lower. They can cut rates, and maybe they don't cut rates. Well, guess what they can do? They can start printing more money on the balance sheet, or increase their balance sheet. And the last time they did that, it was called the Bank Term Funding Program. And that's when we saw bank deposits basically get filled. We didn't have a banking crisis because the Fed basically built a program, $450 billion, to back the deposits of the banks who couldn't pay back their deposits to their customers. So that happens if we get a surprise. If anything happens, you have three tools. You have the fiscal liquidity, you have the Fed printing money, and you have cutting of rates if we're in recession. Now, if inflation goes up, if those oil prices start to spike, there's nothing you have to slow down the economy. You have to really decelerate the economy. And I think that's a bigger risk, but I just don't see it happening because inflation is falling like a rock. Like we said, oil prices are coming down for a lot of technical reasons, and shelter should come in a lot lower at the end of the summer. So that's basically what we're looking at. Do we have any questions? If there's any disagreements, put them in the comments. I'll get back to you, right? Wherever you are, I'll get back to you. I want to answer the questions because it is confusing. And not only that, but I think it's important for people to think about that. Now let's look at some technicals, right? If anybody has any, does anybody want to look at anything technically in the comments? Let me go to, let's look at this. Look at these charts really quick. I think this was the last pullback. Personally, I think this is the last pullback that we will have. And this is basically the S&P 500. right, on a weekly chart. The big level at first was this 4,200 level. This was the big level that we were never supposed to break. And we broke that level at 4,200. And this was the FOMO. This was FOMO 1. We pulled back. We held the previous resistance level at 4,300, basically 4,300. And now we're pushing up again. So we're still in the trend. We're still in this, this uptrend. If we break above this uptrend and stay bullish, it's going to get even more vertical. Now, my call is what I think is going to happen as inflation comes down and a lot of people are still in cash. That's one thing to remember. There's a lot of fund managers or a lot of investors who are still on the sideline in cash because they expect these risks to come in, and we're just not actually seeing it. So this is my target for the end of the year. I think we get to all-time highs based on this macro. If it changes, right, then maybe something changes. But for now, we're still pretty bullish. If we look at the the moving averages, we're now above all of them: the 200, the 50, the 100. And the last thing that to see really here is the 50 move across that 100. Once with the 50 moves, and it looks like it's starting to make its way, then we're really going to be turning up. And a lot of people get FOMO, and I think we're seeing that. Like I said, this is FOMO. This is the second wave of FOMO that I think we see. Now, this week, was this the pullback? It happened rather quickly. The pullback actually happened pretty quick. So we had the blow off top, and then we pulled back into 4,300, like I said, and now we're already making a move back to the highs. So it just seems like, dang, like there's a lot of FOMO in the market, right? A lot of people are under pressure to perform. If they weren't in tech, then if they were not in tech stocks, then they're a little behind. And so when you look at like Nvidia, right, a lot of people are piling into Nvidia. We had the biggest inflows, by the way, into the stock market. They went into Tesla, Apple, and Nvidia. So Nvidia at all-time highs, and it's basically forming some bullish technicals on the chart, right? These are bullish technicals. If you're not familiar with technicals, Nvidia is still moving higher. So there's a lot of FOMO. Why? Because of the AI narrative. And the other part of that is if inflation, let's say you think you're an inflationist and you think inflation's here to stay. Well, AI, what it does is artificial intelligence, what it does is for a tenth of a cost, it's going to increase your productivity. So you get an increase in productivity at the tenth of a cost. There's how you solve GDP. That's how GDP starts to come back up. And we're also seeing analysts upgrade or increase their growth prospects for Q2. What is this, Q2? Yeah, Q2 earnings, right? So we're starting to see that happen too in tech because they've cut so many jobs. They've cut so many employees, and they've replaced those employees with better software or cost cutting in general. Then their earnings are going to be better. They're going to improve. So that doesn't literally translate to the economy. I think the economy continues to slow until we get more fiscal liquidity into the market or we cut rates. But for the most part, the market doesn't need to really go back to the lows. It can keep going higher because it's looking 12 months ahead. It's looking at 2024 earnings. It's looking at the Fed pausing and starting to turn from where they're at now. So that's why. Now the VIX too, volatility is very low. Volatility is basically falling off a cliff, and that's super bullish. Bond volatility is also falling off a cliff, and that's very bullish, right? Now, looking at this is the bearish part, right? I just want to go over some of these technicals, these macro forces. We're seeing a bond yield. So this is the cost of capital actually make new highs. This is not accommodative to the market because what it is it's showing that rates for the stock market are rates in general are still going higher, and that is going to tighten the economy. It will tighten growth in some areas. And that's why I think we're in a stock pickers market, because the market doesn't care if you're tech, if you're AI, it doesn't care about higher rates. What it cares about is that this growth opportunity continues to make progress, and it's happening. So while some companies fall apart, others are starting to improve. Now, turning to Bitcoin, right? Let's take a look at Bitcoin. What's going on here? Well, Bitcoin is technically starting to break out, right? So looking at this big trend, we've broken out of that. We've broken out of the downtrend. We consolidated. We found support at 25K. I think that was really the last piece of support as we enter this bull market. and now it's testing 30K. Once we get over 32, that's it. Like Bitcoin's off to the races. And the basically what you have here is the Bitcoin ETF setup. And what does that mean? What does that actually mean for Bitcoin? Well, the whole bullish narrative going back was that, actually I'll keep it here. The whole bullish narrative going back in time was that institutions would come in, they'd buy Bitcoin, they'd have to own some Bitcoin, and it just didn't happen. It never happened. We thought it was going to happen, it just didn't happen. And everybody who applied for an ETF, and what the ETF does, if you're not familiar, is it opens up a pipeline for big institutions who do not want to get their private keys, who don't want to have private keys and at risk of losing it. They don't want to do all that work. They just want to be able to connect to the Bitcoin price action really and get some Bitcoin, because they know it's a global, there's a lot of demand for Bitcoin anyway. And then what it also does is it opens up the $35 trillion retirement market, which is pension funds, 401ks, and any kind of retirement fund. They're now allowed to, whatever that system is. I know they're doing it in Texas, they're doing it in Florida, where they're going to buy Bitcoin, or they're going to put a small piece of Bitcoin, which they have to buy it, into the fund or into the retirement fund, because it is the best performing asset over the last 10 years. That's over 100 billion. That's a mega cap. That's the size of a mega cap, right? And so the whole BlackRock thing is, why is BlackRock not getting denied? And the reason why BlackRock, I mean, they haven't passed the Bitcoin ETF yet, but what we do know is that BlackRock always gets accepted. Out of 500, I think, now quote me, I could be wrong here, out of 575, 578 ETFs that they applied for, they've been successful every time except for once. So they've only been denied once. And the timing is pretty perfect. You have this, the cycle starting to turn up. There's a lot of liquidity coming in. China's printing money. And now BlackRock is starting to file for this Bitcoin ETF. If that is the case, that is the catalyst for crypto to rise again. Now, from all this bullishness, even though we're in FOMO, I think we're still in FOMO, wave 2 FOMO, like I said, I think this is the fastest horse. Crypto still is the best opportunity going forward. There is nothing else that is going to outperform crypto in general. And crypto as a buzzword for the blue chips, Ethereum and Bitcoin, right? So that's kind of the Bitcoin ETF narrative. Now, when we, because I like Bitcoin and I like Tesla, I'm very bullish on Tesla and Bitcoin. The part about Tesla is, well, you're starting to see the supercharger network, or you're starting to see some of their revenue streams start to develop into the world, right? So GM, Ford, Rivian, ChargePoint, they're all now recognizing that the Tesla supercharger network, the superchargers where they charge the cars, blah, 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 is superior. So they're all having to switch. And if they do have EVs, they're all having to switch and use that supercharger network, which becomes sort of like a lease, or sort of like a subscription model. So there's one revenue stream. Next, you have the Cybertruck coming out third quarter. Hey, it doesn't always happen the way Elon says, but the Cybertruck is enough. It coming out is enough, and it already has over 1 million backlog orders, enough to drive revenues even higher. To increase, and Tesla already has the fastest growing revenue in the automotive space, and it's not really just an automotive company, right? So you have that Cybertruck coming online. You have the supercharger network, and there's a lot of reason to believe. Well, Elon said this the other day, and he says a lot of stuff. You can't, you don't know if it's really going to happen. But full self-driving is the biggest catalyst for Tesla stock in general. It is the biggest catalyst. It'll eliminate Uber. It'll eliminate Lyft from even having a business, or they'll have to go buy electric vehicles. They'll have to buy the Tesla, either start using Tesla cars, or use the software, right? They have a supercomputer too. It's called Dojo, and their supercomputer develops chips for AI in general. You also have not just those cars, but you also have the labor force. Now that might not come online till later, but there's just a lot of revenue streams coming in for Tesla. A lot of good news. So I think this goes much higher. But overall, the Nasdaq is moving up. Overall, the Nasdaq is almost at all-time highs. It's pretty close to all-time highs. And I don't see this stopping anytime soon, right? I don't see this stopping anytime soon. And one of the arguments is there's not enough market breadth. But if we switch over to S&P equal weight, and S&P equal weight is basically looking at the market. You're not weighing the S&P 500 index as in market cap. You're weighing it equally throughout the whole index from all the companies. Now, equal weight is not in a bull market yet, but it is breaking out. It is showing some strength. We've seen it move up lately, and it's holding on there. It's not declining. Okay, it's not declining. If we look at the Dow's doing the same thing. The Dow Jones is holding up. So this would be market breadth, increasing at the same time. It's not like at all-time highs, but it's still pretty close from all-time highs, right? The next thing would be IWM. So small caps. Small caps finally are starting to lift, and we'll see if they actually break out. But for the most part, if you look at the trend, they do seem to be breaking out if you measure it from a trend basis, or at least trying to break out, right? So it's just a matter of time. Now, again, looking at the S&P, it looks like it's trying to break out again. So, at the end of the day, price is king. Price action is king, and price action tells us that people are underweight. So let's take a step back really quick and think about why this can continue. Why can we see this continuation? Okay. And this is a theory that I've had, not a theory, but this is the data that I've been tracking for a while. Let me take a drink really quick before we finish this. Okay. And I'm going to refer to my board. It's a lot of data, but basically what we've seen here, right? Inflation has been the biggest risk to the market. And so far, core PPI, all these inflation indicators year over year are starting to fall. And the stickiness we see is not really sticky. It's just lagging. So Redfin, Zillow, Case-Shiller home pricing, all falling, right? The global supply chain pressure index, which is the supply side of the global economy, is under zero. It's negative. So there's no supply side pressures to push inflation higher, right? ISM, so global manufacturing business activity prices paid, which is short for how much it costs to run business, are declining. So there's no price pressures that are actually happening. They're all falling. So inflation pressures are just not there. And I don't think the market has fully, I think the market is bidding up on that, but a lot of people are still holding cash. They're still expecting inflation to come back. I don't think it happens at all. And that's going to set up for another short squeeze because people are going to get FOMO. They're going to have to buy into the market while they think, oh, these risks are just going to come out of nowhere, right? Number two, the Fed has finally paused. JP Morgan they've done so many surveys, and a lot of the fund managers said, okay, we'll start buying risk again once we see, right? They said that they'll start buying risk again once they see inflation below 5%. Okay, we're at 4% headline CPI. And once the Fed pauses, the Fed is now on pause. Now there's the idea, oh, well, the Fed's going to hike in July. Maybe they do, but they have never, by the way, paused and hiked again. That doesn't happen. They either pause and the pause, holds for about, 6 to 18 months or 12 months. Maybe they pause for a while and then they cut rates, but they never pause and start hiking. So that would be unprecedented. It just never has happened. So the pause is in play, right? The banking crisis. Regional banks are still kind of in recession territory because as long as those money market funds are sucking liquidity or bank deposits from the banks, they're still at risk. So what we're seeing is the bank term funding program is actually funding these banks. So more liquidity is coming into the bank. The risks are disappearing. They're evaporating, like I said, and that's why volatility is coming down. Okay, next, liquidity. China, money growth going higher. China, liquidity in general going higher. Loan growth going higher. The Chinese credit impulse, so loans versus GDP, is going up. Okay, their retail sales. Now, they're not as strong as we thought they should be coming out of the pandemic, but they will keep. China's inflation is non-existent. Their producer prices are negative. What does that mean? That gives them room to keep the gas, keep the foot on the pedal. That gives them room to keep printing more money into their capital markets, into their economy. So I expect China to continue to stimulate, right? And why wouldn't they? Their growth is slowing and they can afford to do it because they have no inflation. So that's another bid for global growth to pick up. And if you're a multinational, let's say you're Tesla, let's say you're Apple, and I think this is why they're going higher also, you're a multinational, so you have business in China, right? You're running corporate, your corporate you're running cars, whatever it is that you do, you're running in other countries. Now, if China keeps stimulating, that automatically is going to push demand for your product higher. If you have the best product, well, I mean, yes, they have the best products, right? That's why they're multinational. That's why these companies are mega caps. So demand goes up, that pushes revenues higher. So earnings actually look better than expected. And then you go to Japan. The Bank of Japan is also increasing the Fed's balance sheet, or not the Fed, their central bank balance sheet. So Japan is also stimulating more liquidity. Okay. We look at the US, we know there's the infrastructure, the CHIPS Act, and the Inflation Reduction Act, and now this Internet Act, whatever you want to call it, Internet Bill, more liquidity from the fiscal policy. If something fails, the US prints, we go higher. Okay. So this is just nothing but bull. And I don't say it's really complicated, but there's so many reasons that we are going to all-time highs if there's no black swan event. Okay. Positioning. This is probably the most bullish reason that the markets are going higher. People are underweight stocks. And the more they stay underweight stocks and the more the market keeps running higher, the more they get FOMO, the more their clients are ready to get rid of them for not buying tech. So every pullback, I think, gets bought up because everybody wants a piece of Nvidia, Apple, Amazon, Google, Facebook, Tesla, Meta, Meta, whatever, maybe even Netflix. Everybody wants a piece of it because they're seeing that they can still grow their earnings being in a recession, because they can cut costs really quick, improve their margins, and still grow revenue. Okay. By the way, every month 401ks are still buying the market. So you have an unlimited bid into the market. You have this consistent bid from 401ks, bullish for the market. Triple B spreads. This is a little more complicated. We don't need to really go over it, but basically corporate debt is still being bought. So investors are still buying corporate debt, which means they're taking risks. So risk conditions are still positive. Okay. And basically, and I'm trying to think all this through. There's a lot of reasons to be pretty bullish, and I think that pretty much hits all of them. Now the risk to the market, right? Um, well, not the risk, but the earnings trough. So what we saw in this last S&P earnings, so the stock market earnings, is that the S&P was expected to be -6. Just as a number, -6. We came in at -1.2. So we're starting to see earnings in general start to bottom out. Now maybe we're still negative next quarter, but the estimates are starting to improve. And as long as the estimates improve, the market is looking forward to estimates actually going higher. And as the labor market, as consumers keep spending, as we see an expansion still take place and GDP come out better than expected, and the global economy, Japan and China, keep stimulating, as well as India too. India is still stimulating also. Their markets at all-time highs. That just gives more. This is just a macro outlook, but it gives more reason to be pretty bullish on the market. Okay. Now, we see market breadths coming up. Global breadth is also pretty strong. So the German DAX all-time highs, the Japanese Nikkei hit, man, like a 30-year high. And so other markets are still bidding up. And I think it's because this global liquidity cycle is starting to turn up from the bottom. So M2 in general, global M2 is starting to turn up. Yes, the US's money growth is still negative to some degree because we're tightening credit conditions, but they're starting to improve in Japan. They're starting to improve in China. And eventually, we're pretty close to the Fed starting to cut rates because inflation is coming down, and that is the biggest dragon that we need to solve. And I think that's pretty much covers everything. I think the last thing we need to see is the dollar actually break down for super risk to come back on the table, or for bond yields to come down. But until then, that pretty much wraps it up. I'll have the link in the description for the macro newsletter. If you don't have any questions, I appreciate you guys checking in. I'll be live Monday through Friday, trading the market, doing more technical analysis on the market. If you guys have no questions, then I'll get going. But again, appreciate the time, and remember, liquidity is everything.